Welcome to the Deep Dive.
Great to be here.
Today, we're zeroing in on something pretty interesting. It's right at that crossroads of crypto and, well, normal business spending. Stablecoin-backed corporate cards.
Yeah, it's a really active area. And we're drawing from a recent article that really lays out what's happening and why it's actually significant.
Exactly. So think of this as us unpacking that source for you. We want to really dig into, what these cards are, how the mechanics work, which is quite clever, and why businesses are even looking at them now.
And we'll cover the upsides, the potential benefits the article mentions, but also importantly, the challenges too.
Right, the hurdles. We're sticking strictly to the source material here, pulling out the key stuff directly from that article.
Yeah, getting you the core insights from the piece you shared, basically.
Okay, let's jump in. So just fundamentally, what exactly are we talking about with these stablecoin-backed corporate cards? Why now?
Okay, so at their core, they're payment cards for companies, but instead of linking to a bank account with, say, dollars or euros, they link directly to a digital wallet holding stablecoins, things like USDC. So companies can spend that digital currency on, regular business expenses.
So it avoids the whole traditional bank account link or like a credit line.
Exactly. It's funded directly by the stablecoins they hold.
And the big idea, reading the article, seems to be connecting these two worlds, right? Blockchain assets and the normal financial system we all use.
Precisely. Making it smooth, frictionless to actually use that crypto value for real-world stuff.
So businesses can just tap into their digital holdings, spend it like a normal Visa card, basically anywhere.
That's the goal, yeah. Global acceptance using existing networks like Visa, but funded from their stablecoin wallet.
That sounds almost deceptively simple. Spending crypto for like coffee or software subscriptions. How does the article say it actually works? The mechanics behind it.
Yeah, that's where the tech gets interesting, and the article breaks it down nicely. First step, the business loads up stablecoins. Let's stick with USDC as the example, into a digital wallet. And that wallet is connected to the card. Now, this wallet could be one they fully control themselves, or maybe one managed by the card platform.
It's kind of like topping up a prepaid card, but with USDC instead of dollars.
That's a good way to think about it, yeah. Then, you go to make a purchase, swipe the card, tap it, use it online, just like normal.
Okay, standard purchase. Then what happens? What's going on behind the curtain at that point?
Right. This is the key bit the article focuses on. Real-time conversion. When that transaction starts, the platform behind the card instantly takes the right amount of USDC out of that linked wallet. At the same time, almost instantaneously, it converts those stablecoins into whatever local currency the shopkeeper needs. Dollars, pounds, yen.
Wow. Okay, so the business is definitely spending their USDC, but the store, the merchant, they just get regular money. They don't even need to know crypto was involved.
Exactly. That's the seamless part. The Visa network or whoever just processes the payment like any other card transaction. The merchant gets their fiat money right away.
So the system handles that whole crypto to fiat swap invisibly, using the existing payment rails.
Yeah. The article describes it as making digital assets instantly usable, instantly liquid, anywhere Visa is accepted. Pretty powerful.
And the article mentioned there are sort of two main ways this wallet part can be set up, custodial and non-custodial.
That's right. So the custodial model is where a third party, like the card platform itself, holds the stablecoins for the business. They manage the wallet, the conversions, everything, usually through APIs connecting it all.
Okay. Sounds maybe simpler for the business user?
Potentially, yeah. The article suggests it can be easier to get started. But
what, you're trusting someone else with your crypto keys, essentially.
Correct. Which leads to the other model, non-custodial or self-custodial. Here, the business keeps full control. The stablecoins stay in their own wallet on the blockchain.
And how does the spending work then, if they hold the keys?
Well, the article explains that often smart contracts are used. These contracts directly on the blockchain handle the transaction approval and trigger that real-time conversion when a purchase is made.
So you can spend without giving up custody. That seems like a big deal for people really into the self-sovereignty aspect of crypto.
It is. It definitely speaks to that core crypto principle. Technically quite a feat to make it work smoothly with traditional card systems, too.
Absolutely. Injecting blockchain function into a familiar tap-to-pay experience. So, okay, why are businesses actually adopting this now? What are the big advantages the article points to? Global acceptance seems like a huge one.
Oh, massive. Being able to use stablecoins at tens of millions of places globally that already take Visa, That's a game changer. It makes digital assets suddenly practical for everyday international business.
Yeah, instantly usable. And the article also brought up financial inclusion. How do these cards fit in there?
That's a really interesting point it makes. In some developing economies, stablecoins are already being used, for savings or sending money, partly because they might be more stable than the local currency.
Right.
So these cards let people or businesses in those regions actually spend that stable value easily, anywhere. It could really help businesses in places with, say, volatile currencies or limited banking access connect better to the global market.
That's a really powerful use case. What about efficiency? Lower costs, faster settlement times? The article mentioned those.
Yeah, think about international payments the old way. Wire transfers, correspondent banks. It can be slow, take days, and the fees add up, especially for business-to-business stuff.
Definitely.
The article suggests that using stablecoins with their direct blockchain transactions plus that instant conversion can cut down those costs and delays significantly. That's huge if you operate internationally or just do a lot of transactions.
That makes sense. And transparency. Blockchain's always talked about for that.
Right. The article notes that since it's all on the blockchain, businesses get this, real-time view of their spending.
Yeah.
Much better visibility, easier tracking compared to waiting for a monthly statement.
Better oversight, budgeting,
Yeah.
Security is also listed, using blockchain features.
Yeah. The cryptography behind blockchain offers strong security, potentially cutting down certain fraud types you see with traditional cards. Although the article rightly balances this, it points out new risks too, right? Wallet security, phishing attempts targeting crypto users. Businesses need to be careful.
And flexibility too, like linking to Apple Pay. Just ease of use.
Exactly. Familiar interfaces.
So where is this actually being used? What are the real-world applications the article highlights? Expense management seems obvious.
Yeah, that's a natural fit. Paying for employee travel, software, office supplies, just funding it directly from your stablecoin balance instead of a bank account. It could really streamline things, cut down admin work.
What about payroll? Especially, with remote teams everywhere now, international contractors.
Another really strong use case mentioned, paying people in stablecoins, maybe contractors overseas. They get the funds fast, low fees compared to international wires, and then they can immediately spend it using their own card.
Solves a real pain point for distributed companies.
Definitely. And then there's treasury management for companies already holding crypto.
Right, if you're already sitting on a pile of USDC, for example.
Exactly. The article points out, this is a big one, instead of having to constantly convert large chunks of stablecoins back to fiat in a separate step just to pay bills, you can just spend directly from those reserves for your operating costs. Keep your assets in stablecoins, but still have that instant real-world spending power. Much more efficient treasury.
Okay, this sounds really promising on many fronts. But who's actually building this, making it work? The article talked about key partnerships.
Yeah, you need the big players involved for this to scale. Visa is mentioned prominently in the article. They're actively working on integrating digital assets.
Right. And they're partnering with specific companies. Bridge and Baanx were named.
Correct. Bridge, which the article notes is owned by Stripe now, they worked with Visa initially in Latin America, places like Argentina, Colombia, Mexico.
Okay.
Bridge provides the tech, the APIs, that lets other fintechs or businesses issue these stablecoin-funded Visa cards.
And Baanx. They were linked more to that self-custody model.
Exactly. The article highlights Visa's partnership with Baanx specifically for cards linked to self-custodial wallets, starting in the U.S. So businesses hold their own USDC, and Baanx Tech handles the instant conversion at the point of sale, often using those smart contracts we talked about.
And that's expanding internationally too, apparently.
Yeah, plans for expansion. So Visa's strategy, reading between the lines in the article, seems to be enabling both models. Custodial via partners like Bridge, non-custodial via partners like Baanx.
Catering to different needs,
Yeah.
Control versus maybe simplicity.
It really shows they're serious about embedding digital assets into the mainstream payments world, giving businesses choices.
Okay, but it can't all be smooth sailing. New tech always has bumps. The article was pretty clear about the challenges too. Regulation seems like a big one.
Oh, yeah. Navigating the global regulatory maze is complex. The article points out rules for stablecoins, for crypto payments, for financial compliance. They're different everywhere. You have frameworks like MiCA emerging in Europe, which helps clarify things for certain stablecoins, but it's still a really patchy landscape globally. Operating across borders is tough.
And security risks. beyond just the blockchain itself being secure.
Absolutely. The article warns about that. Despite the blockchain security, users face risks like getting their wallet hacked, losing private keys, falling for phishing scams. Robust internal security, maybe hardware wallets, multi-sig setups becomes critical.
Right. New technology, new threat vectors. Market volatility is also listed, which feels weird for stablecoins.
Yeah, that's a subtle but important point the article raises. Stablecoins aim for stability, usually 1.1 with fiat, but how reliable is that peg?
Depends on the stablecoin, right?
Exactly. The article raises concerns about the actual stability, or the liquidity, or even just the general acceptance of some stablecoins, especially ones backed by, say, algorithms or less transparent reserves.
So the quality of the specific stablecoin matters hugely.
Critically important if you're relying on it for daily operations. The article mentions USDC, used in the Visa partnerships, is generally seen as robust. But it also mentions things like Pax Gold, backed by physical gold, showing the variety. You need confidence in the underlying asset.
Okay, that makes sense. And finally, competition. From potential central bank digital currencies, CBDCs.
Yeah, that's a longer-term question. Many central banks are exploring CBDCs, digital versions of their own national currency.
How does that affect these cards?
Well, the article suggests that while CBDCs could offer similar benefits someday, widespread rollout is likely still years off for many. These stablecoin cards, working now through existing players like Visa, they offer a practical solution today. They have a head start, especially for cross-border stuff, compared to waiting for CBDCs.
So managing these challenges, regulation, security, stablecoin quality, future competition is key to successful adoption.
Absolutely. It requires a clear-eyed view of the risks and putting the right strategies in place, as the article implies.
Looking forward then, what's the outlook, according to the article? Seems pretty positive overall.
Yeah, the forecast seems to be for pretty strong continued growth, probably driven by tech improvements, maybe AI for better fraud detection, or more automation and reconciliation, making things even smoother for businesses.
And wider adoption, too. Especially maybe for smaller businesses or in those emerging markets we talked about.
Seems likely. They offer a really efficient alternative where traditional banking might be clunky or hard to access for SMEs or startups. Opens up possibilities.
And just generally, this deeper integration of digital assets into mainstream finance through these kinds of partnerships, it feels significant.
Yeah, the trend highlighted suggests these aren't just a temporary fad. They're becoming, potentially, quite integral tools for businesses operating in this increasingly digital global economy, offering real flexibility and efficiency.
Okay, so let's quickly recap our deep dive, drawing from that source article. We've looked at what stablecoin-backed corporate cards are fundamentally.
Yeah, linking digital wallets, not bank accounts, for spending.
We explored how they work, that key real-time conversion magic happening behind the scenes.
And the difference between the custodial model, where someone manages the crypto for you, and the non-custodial one, where you keep full control.
Then we hit the advantages, global reach via existing networks, potential cost savings, speed, better transparency, financial inclusion.
Plus real-world uses like expense management, international payroll, and much more efficient treasury operations for companies holding stablecoins.
We saw the critical role of big partnerships like Visa working with Bridge and Baanx to actually build this out.
But we also covered the significant hurdles the article points out. Navigating complex regulations, managing new security risks, ensuring the stablecoins used are genuinely stable, and thinking about future competition like CBDCs.
Right. So hopefully this gives you a really solid understanding, based on the source, of how business finance and digital assets are starting to really intertwine. It could fundamentally change how companies manage their money.
Which brings us to a final thought, something provocative for you to chew on, building on what the article discussed. It mentions that the total value transferred using stablecoins already outstrips the combined volume of Visa and Mastercard.
Wow, okay.
So if these new corporate cards make spending those vast stablecoin sums as easy as tapping a regular card, how profoundly could that shift global business, especially for international trade or for businesses operating in countries where the local currency maybe isn't so stable? What does that future look like?